Welcome back to Around the Table with Stacy Smith. We're continuing our discussion on investing in the economy. And if you have been with us for previous chapters, then you know that my panel of advisors always preach about having a diversified portfolio. Whatever kind of portfolio you might have, it is difficult not to pay attention to the big swings in the market. So, Bob, how important is it to try to keep your emotions in check when you see these, 300, 500, even 800 point swings, let's say in the Dow or even the NASDAQ?
Well, an unreasoned emotional response to market fluctuations or to an adverse stock price movement is the single greatest cause of investment losses. A good analysis, a plan become upended by fear and emotionalism. Well, history is no guarantee. History is still our best guide to the future. And when markets drop and investors panic, they condemn themselves to losses and can never be sure when to re-enter. Timing the market doesn't work. Time in the market has proven its worth. So staying with a well-reasoned, asset-allocated model and an intelligent investment selection beats emotional reactions to market movements. And I will say emotionalism works in two ways, fear and greed. We've heard the expression often. So one can become emotional over an overly strong bull market and take risks that shouldn't be taken. So we have to treat this as a business. The stocks don't know your name is on them. It's a tool, and we got to treat it like business tools, not a reflection of our personal self-worth. But so often we vest ourselves in those stocks.
Yes.
100 years before Bob and I got in this business, somebody asked, I think it was J.P. Morgan, if someone knows differently, fine, but I'm not sure it matters who was a very successful investor. Somebody asked him how he was so smart. And he said, I really wasn't that so smart. All I did was accommodate the people. The man that said this recognized that the people acted emotionally instead of intelligently. He accommodated the people. When they wanted to sell, he assumed they were wrong and emotional, and he bought. When they wanted to buy, he assumed they were wrong, and he sold, because he played off the emotion of the events. There are money managers now. One, Fuller and Thaler, wrote a book about rational investing, because most people are irrational. And they took the behavioral sciences and applied it to investing, and they're running a mutual fund doing that. And it hasn't done as well as the indexes over time, but it's a lot flatter ride.
So I had a client once, hopefully he's not going to watch this, say to me, he looked at the portfolio and he said, these stocks that haven't done well, let's get the bad players off the field and let's get the good players on the field. And my response is, that's exactly the opposite of what we want to do, because it's generally those things that didn't perform, like bonds last year, that have a better chance of performing this year. The key is to get the right mix. We want an all-weather portfolio. And if you have the right portfolio, not everything is going to be working at the same time for the same reasons. When we see portfolios up, if we're doing an analysis and we're estimating that a projected return is 5.5%, well, those years when that client portfolio is up 15, 20%, we tell our clients, don't get used to it, because we're going to give some of that back at some point. So this is all about the theory behind investing and not market timing.
And I'm going to bring up the fact that other than this program, the financial press would like you to trade as much as possible. And when the market's going down, they're going to try to present people that are saying, get out of your basket of stocks and get into this other basket of stocks. And that is another form of market timing. So earlier in this year, we had people saying, get out of, well, they were kind of right. Some of the growth stocks you should never have been in, but just say some of your portfolio was growth, some of it was value. They were saying like, make this big move towards value. That's great. But when the country rebounds and our markets start going back up, you're going to be left with this basket of slower growth stocks, which aren't going to grow as much. So you have to have, even in your equity portfolio, a nice balance between growth and value. So don't ever fall for what people are telling you to take action, take a lot of action. I think having a little bit of a relaxed attitude to what's in your portfolio is the best way to go.
I'm sorry, Bob, but
Go ahead.
we can't have market timing, but we do have to time this program, and we are now out of time, unfortunately. So I want to thank all of you once again for joining us for Around the Table with Stacy Smith, and I want to thank all of our guests here, obviously, but also I want to urge you to join us again for the next time for Around the Table with Stacy Smith.